Hello and welcome to another Ferrari Financial US market news summary. Well, of course, the big news this week was on Tuesday when the Federal Reserve cut another 3/4 point off the interest rate. But the market had really factored in a 1% cut by and large. So after an initial little disappointment, which showed with the index dropping for the first hour after the Fed's announcement, there was a rally towards the close, quite a sharp rally that pushed the markets up very strongly. But this didn't last. On Wednesday, the market decided to sell off and some profit taking ensued, and the market took back most of its gain that it had received from the Fed's announcement. And then, of course, we had a reversal again on Thursday when, just before the Easter break, the market decided that all in all, the Federal Reserve had done enough this week to stimulate the market with its rate reduction and also the injection to extra liquidity and its deal with JP Morgan Chase to help it buy out the ailing Bear Stearns earlier in the week. So all in all, the market decided that it was time to pick the indexes up a little bit, and the market closed for the Easter break up for the week and looking a little bit healthier. The question, of course, is now, will the rally continue into next week? Will this little euphoria that we saw in the market at the end of the week continue? The chart is difficult to really analyze at this point because the downside break wasn't really convincing at this point. Let's take a look at our Nasdaq chart once again. We're going to take a look at the 1-year chart now for the Nasdaq Composite Index. We want to focus really on the events of the last few weeks, where we've had this massive sell-off really since the beginning of the year. Really from just before Christmas, we had this continual sell-off right the way down till the Nasdaq actually just above the 2,200 mark at 2,208 was the worst level before we had the pullback that we've had in the last week or so on the promise of a nice fiscal package with some tax cuts, and of course the Federal Reserve stepping in with an interim interest rate cut followed by further cuts at their end of January meeting. And this very nicely pulled the market back up, as you can see here, coming back up to this line, this brown line, which is in fact the long-term 200 moving average. This is a long-term average line, and when you see that penetrated, that's always a bad sign. We're back up to it now, but we do feel that if we look at the trend line that's forming, possibly covering the peak, and then across the pullback that we had just before Christmas, we're heading down at an angle of something like that. If that's the case, I'll just set that in so you can see it. There we go. Oh, and one more try. There it is. Now, if we see this pullback coming back up to about, at the most, about 2,500, then we're back up to where that trend line would intersect it around about here, and that's probably the danger point where this market could turn south again and continue what would be a much more prolonged downtrend. We do think this is probably the scenario going forward into the spring and early summer, because we do feel that we've seen the head and shoulders pattern fully developed here. The right shoulder, the left shoulder here, followed by the head pattern, and then the right shoulder forming just before Christmas. Now we've had the penetration of the long-term average line, and we do think that in a classic scenario we would see a little bit more of a pullback or consolidation over the next few weeks before then the market would probably turn southwards again. So the market may well continue its upswing next week. The rally may continue with the Fed injecting enough liquidity and enough hope in the market with the 3/4 point interest rate that the economy will receive a lift from the overall package now on the table. And we may feel that the market will decide to consolidate further, and then there's that possibility that the market will decide that it's time to start moving upwards gradually again. We feel that this possibility is based on two issues going forward. The first one is, has the market decided that the recession is going to be very short-lived, short and sharp, and therefore it's discounting 6 months ahead that conditions will be better in the fall of this year? The second issue is how much more bad news is coming out of the financial sector. Is the worst over? Is there enough liquidity in the system now to bail banks out of their tight credit situation? And the financial crisis that we've had over the last 2 to 3 months is probably past its worst point. And if the market decides that these two issues are really resolving, then we could well see a rounding bottom forming to this market and a gradual improvement to the situation from this point on. Our own personal view looking at the overall situation is still rather more pessimistic than that. We do feel that there could be a recovery up to the lower border of the consolidation pattern that we saw forming over the last month. And then there could be resistance at that point, and the market could well turn south once again. We'll be watching the situation very carefully and digesting the news as it arrives on our desk. Until next week, it's goodbye from London.